Every investor dreams of finding a way to make money easily, hoping for investments that bring financial freedom. Imagine having investments that work hard for you, creating a steady flow of income without constant worry. While many strategies have come and gone, there's one that has proven to be reliable over the years: investing in dividend-paying stocks. This method is all about putting your money into companies that pay you back regularly, simply for holding onto their stocks. It's a way to earn money consistently without the need to constantly watch the markets or make frequent trades. Essentially, it's about making your money work for you, generating income in a way that feels almost effortless. But this raises a crucial question. Which dividend stocks are the right ones to invest in? Can they truly offer financial security to investors of all experience levels? Everyone looks for guidance in making these decisions, and who better to turn to than the Oracle of Omaha himself, Warren Buffett? His recommendations on stocks are highly sought after because they come with the assurance of reliability and long-term growth. One key principle for dividend investing is that you shouldn't rush into buying stocks unless you're ready to commit for the long term. This means not just having the financial means to invest, but also the mental readiness to stick with your investments through the ups and downs. Buffett advises that the right approach to stock investing is a patient and thoughtful one, focusing on stocks that you would be comfortable holding forever. Finding stocks that you can buy and hold for a very long time, like decades, is not easy. Everything around us, including the economy, is always changing, and this can make long-term investing risky. But getting dividends from big, successful companies that are leaders in their industries and are either stable or growing is probably the best option for someone looking to invest for the long haul. In fact, since 1930, dividends have made up about 40% of all the money people have made from the stock market. When it comes to investing for a long time, Warren Buffett is the best example we have. He's well known in the world of investing, and every year thousands of investors flock to the Berkshire Hathaway meeting just to hear him speak. Buffett is famous for holding on to his investments for a very long time and has a huge collection of investments in both public and private companies. He's one of the top investors worldwide because of his strategy and success over the years. Warren Buffett likes stocks of companies that not only grow their profits every year, but also share those increasing profits with their shareholders through dividends. A company that can do this usually has many of the qualities Buffett looks for in good investments. And when you can buy these stocks at a fair price, they could boost the value of your investment portfolio. In fact, more than half of the companies in Buffett's company, Berkshire Hathaway's investment portfolio, pay dividends. This is true even though he has sold off shares in some big, well-known companies like Johnson & Johnson and Procter & Gamble. Throughout the remainder of this video, we're going to follow Warren Buffett's strategy to show you the top 7 dividend stocks that are worth buying and holding forever. We'll explain why these stocks should be part of your investment plan, how they can give you a steady income, and the chance they offer for your wealth to grow significantly. Let's dive right in. Number 1, Visa. The number 1 dividend stock on our list is Visa. Warren Buffett has kept shares of Visa in the investment portfolio of Berkshire Hathaway for more than 10 years. During this time, Visa has not only performed better than the overall market, but it has also increased its dividend every single year. Visa enjoys a significant competitive edge, something Buffett always looks for when evaluating a company. As the largest payment network in the world, Visa is often the first choice for banks that want to issue a new credit card, especially one that can be used all over the globe. The only other network that even comes close to Visa's reach is MasterCard, which is also part of Berkshire Hathaway's portfolio. For any company attempting to start a payment network from the ground up, it could take years, or even decades, to match the scale of Visa or MasterCard. The move from using cash to making payments digitally is great news for Visa. This is because Visa has already set up its payment network, so the small amount of money it makes from each transaction adds directly to its profit. The company gives back almost all of its increasing profit to its investors, using both dividends and a program to buy back shares. Right now, Visa prefers to buy back shares, having planned to repurchase $25 billion worth of shares over several years. In contrast, Visa paid out $3.75 billion in dividends last year. However, with the almost $20 billion coming in each year as free cash, Visa has a lot of room to increase its dividends, something it has done every year since it became a public company in 2008. Visa stock is seen as more affordable compared to before and to its competitor MasterCard, trading at 26 times its expected earnings, while MasterCard trades at about 30 times. As Visa's value continues to grow every year, and their dividend has continued to increase yearly, this is truly a great company to consider as part of your investment portfolio for the long term. Number 2, HP. HP is another dividend-paying stock that Warren Buffett's company Berkshire Hathaway has invested in. With a market value of $30 billion and a dividend yield of 3.78%, HP represents 0.8% of Berkshire Hathaway's portfolio. Berkshire Hathaway owns a 9.7% stake in HP, making it the company's third largest shareholder behind Vanguard Group and BlackRock. Berkshire Hathaway started buying HP shares in early 2022. By April, they had 121 million shares, making HP's stock price shoot up by 15% and giving Berkshire a quick profit. But now they've sold some and have 102.5 million shares. Although the investment's value has dropped a bit, HP still looks good because it's priced low and rewards shareholders well. Last year, HP increased its dividend twice, leading to a 3.78% dividend yield, which is much higher than the average. Plus, HP bought back $100 million of its stock while paying out $1 billion in dividends, showing it's good at giving value back to its investors. This makes HP an important part of the Berkshire Hathaway investments. HP has $3.6 billion in cash, so it can easily keep paying its good dividends, making it one of Warren Buffett's favorite dividend stocks. Berkshire Hathaway, owning 102.5 million HP shares, will get nearly $113 million in dividends from HP next year. Buffett is happy to earn these dividends while waiting for the stock's value to go up. HP's commitment to returning value to shareholders through dividends and buybacks reflects the financial discipline Buffett seeks in his investments. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price, Buffett has stated. And HP's evolution and financial strategy illustrate its status as a wonderful company in his eyes. Number 3, CocaCola. Moving on to the third one, Warren Buffett has been investing in CocaCola, a big drink company, since 1988. Over the years, he's bought more and more shares of the company. Coca-Cola has been increasing the dividends it pays to shareholders every year for 61 years. Right now, it pays a dividend of 46 cents for every share someone owns, 4 times a year. As of July 18 last year, the yearly dividend return, or yield, you'd get from owning the stock was 3.01%. In the first 3 months of 2023, Coca-Cola made $11 billion, which is 4.8% more than what it made in the same time frame in the prior year. They also had cash flow from their operations amounting to $160 million during this quarter. Looking ahead, Coca-Cola is projected to have about $9.5 billion in free cash flow for the whole year of 2023. By the end of March 2023, 61 hedge funds, as reported by Insider Monkey, had invested in Coca-Cola with their investments totaling over $24.8 billion. This makes the company a good investment choice for a long-term portfolio. Number 4, American Express. Another dividend stock company you can consider is the American Express Company. It is a well-known financial services company in the U.S. that focuses on payment cards. Recently, they increased their quarterly dividend to 60 cents per share, which is a 15% hike from the previous amount. They've been consistently paying dividends to their shareholders for 30 years straight. American Express is considered one of the top dividend-paying stocks that Warren Buffett has in his portfolio, alongside other giants like Coca-Cola and Chevron Corporation. Buffett's stake in American Express highlights his preference for companies with strong competitive moats and brand loyalty. Price is what you pay. Value is what you get, Buffett has noted. and American Express's ability to maintain high spending per cardholder reflects the value proposition it offers to both customers and investors. In the first quarter of 2023, the number of hedge funds owning shares in the American Express company, as monitored by Insider Monkey, increased to 77 from 71 in the last quarter of the previous year. The total value of their investment in American Express is now more than $27.3 billion. Number 5. Occidental Petroleum. Next on our list of top dividend stocks is Occidental Petroleum, also known as OXY. This company has been standing out in the market, especially with a remarkable 91% increase in stock price from 2022 to 2023. Berkshire Hathaway, led by Warren Buffett, has significantly invested in Occidental, holding more than 20% of the company following the events in Ukraine during 2022. By March 2023, the stake had increased to about 23.6%, equal to approximately 211.7 million shares valued at around $13 billion. But what makes Occidental so attractive for a major investment? For starters, Occidental is at the forefront when it comes to technology, showcasing some of the most efficient drilling practices in the industry. Additionally, during the acquisition of Anadarko, Occidental owned about 23% of the top-performing wells in the Permian Basin, even though they had less than 5% of the total wells in the area. Looking ahead, Occidental has shown a strong potential for growth with its investment in low-carbon technologies. Despite its low price-to-earnings ratio, which makes the stock appear undervalued today, Warren Buffett's strategy of holding stocks for the long run fits well with Occidental's extensive project inventory and advanced technology. With its current success, near-term prospects and long-term potential, it's clear why Occidental Petroleum has become a key holding in Berkshire Hathaway's investment portfolio. Number 6. JP Morgan Chase. JP Morgan Chase stands as one of the globe's largest banking and financial institution, boasting around $3.4 trillion in assets under management. In a comprehensive interview with Yahoo Finance's editor-in-chief Andy Sewer, Warren Buffett expressed a candid reflection, stating, "I should have bought more JP Morgan stocks." This admission shows Buffett's high regard for the banking giant's value and potential. In early 2023, several bank failures put pressure on the financial sector. However, JP Morgan Chase saw this as an opportunity and stepped up to buy First Republic Bank after it was taken over by the Federal Deposit Insurance Corporation. According to analyst Betsy Grasek, JP Morgan is not only increasing its market share but also boasts a very strong balance sheet, with capital levels significantly higher than what regulators require. Morgan Stanley has given the JP Morgan stock an overweight rating and set a price target of $221, even though it was trading at $175.43 on February 7. The ability of a stock to consistently deliver strong returns through both capital growth and dividends is crucial. That's one of the reasons why JP Morgan Chase is an excellent choice for those looking to start investing in dividend-paying stocks. Number 7. UPS. Lastly, let's talk about UPS, the biggest delivery company in the world. Founded in 1907, UPS now works almost everywhere around the globe. Its value in the market is $94.02 billion. Over the past 10 years, UPS has increased its dividends by an average of 8.3% annually, while its earnings per share have gone up by 4.6% during the same period. Right now, UPS offers 2.9% dividend yield to its investors. Combining this yield with its growth rate, people who invest in UPS could see their money grow by approximately 7.5% each year, assuming UPS keeps growing as it has been. A 7.5% growth might not seem super exciting, but having a safe investment is important, and UPS's dividends are very reliable. The company only gives out 54% of its earnings as dividends, which is a good balance. Plus, UPS has been raising its dividend every year since 2001, even during tough times like the Great Recession. UPS has a strong advantage in the delivery industry because they can ship almost anywhere, like Tunisia, which smaller companies can't match. As UPS grows, it becomes more efficient, promising future growth. Currently, its stock has a price-to-earnings ratio of 19.2, lower than the S&P 500's 24.8, making it a good value. Warren Buffett's investment recommendations are not just about stock picks. They embody a philosophy that champions the value of patience, discipline, and a focus on fundamentals. Which company are you considering for investment? Share your thoughts in the comments section below. We hope you enjoyed this video. If you found this video helpful, please like and subscribe for more valuable content. Additionally, please share this video with someone you know who could probably use this information. Thanks for watching.